Hey everyone, welcome. Got lots of people on already. We'll give just a quick little intro on what we're going to be talking about today and let the rest of us join. I'm super excited to be here. I'm really passionate about the topic that we're going to be going over today. We're going to be talking about internal controls, but with a slightly different spin. Not in a way of, hey, these are things that you should be doing without any practical insights on how to implement them. I come from some experience as a former auditor that used to write up recommendations and suggestions for nonprofits to incorporate within their organization. And then I actually switched over into a CFO position at a nonprofit. And I had to then be the one to implement all of these internal controls. And wow, isn't it so much easier to suggest those controls than it is to actually implement those controls? So those are some of the things we're going to be talking about today. What are the things that we are seeing with our clients that have come up in past audits that we're trying to resolve for them? And what practical ways can we roll those changes out that are not going to be overly burdensome to the small nonprofit teams that we work with? So I'm going to go ahead and share my screen. Don't worry for anybody that's trying to frantically write this down. We've launched a new website. It's hot off the press. It's launched late last week. We now have a new resource section on our website. And what we're doing is capturing all of these webinars and putting these webinars up on our website. So if you find this information useful, you want to share it with a colleague or another team member of yours to watch, or you're only to plug in for some part of this conversation, no worries. It is recorded. It's going to be on demand and it's going to be on our website. So hop on over there to the charitycfo.com and go to the resource tab and you'll be able to find the recorded webinars there. So a few more little housekeeping things now that we have several more people that have already joined us. Please utilize the question and answer section. I'm sure there's going to be lots of questions or even just comments, or if you just want to be validated with your frustrations and all of this, that's okay too. Go ahead and put that in the chat. I have Kim from my team also kind of moderating that chat, and we'll be using the question and answer, not the chat. I'm sorry. Question and answer to be able to identify which questions are coming in first or what questions seem to be trending the most. And I will do my best to leave plenty of time at the end of this conversation to address any of those questions. So with all of that, if you all have not had a chance to meet me before, I'm Tasha Anderson. I'm the managing partner and founder of the Charity CFO. Some of you all might already know us, and you may need no formal introduction, but the reality is we are a boutique accounting firm. We do outsourced accounting services for nonprofits. We only work with nonprofits. I've been doing this work for about 20 years, and I started this firm about 9.5 years ago in the spirit of taking all that I've applied in my previous life and doing it in a fractional way for small to mid-sized nonprofits. But that's enough about me. That's not why you're here. Let me go ahead and share my screen, launch some of the content, because if you're like me, I'm a bit of a visual person, so I like to pair what I'm saying with some visuals to help try to make some of this technical accounting stuff seem a little less technical. So bear with me real quick. All right, Kim, everything look good on your screen?
Yeah, looks good.
Awesome. Well, let's go ahead and dive into it. All right. Like I said, I'm Tasha Anderson. For those of you that just joined, I have quite a bit of experience in this auditing space with respect to nonprofits. For many years, I worked for what is now a national firm, and I was a nonprofit audit supervisor. So I audited many, many nonprofit organizations. And then I switched sides of the table, if you will, and I worked as a CFO for a mid-sized nonprofit organization that had very complex government funding. And I did that for several years before I started this practice 9.5 years ago. I share all of that because that gives you a little bit of context for kind of the lens and the approach for which I'm kind of bringing this conversation. So I feel like I've sat in all of these different parts. And now, interestingly, I've got over 200 clients we work with every single month. And over, I think, 84% of them get audited every single year by a formal financial statement auditor, in addition to numerous other audits as a result of their government funding, whether it's federal, state, or local funding. So we know a thing or two about audits and how to get through audits in a pretty effective way. So today we're going to be talking about those internal controls that funders and auditors expect. So what are they looking for, which may be different than what you're thinking? How to implement controls to keep those auditors happy and not writing those recommendations that then end up in your funder's hands or your board's hands. And then I want to share the tech stack that we use and trust to make sure that we are audit compliant, that we call that audit ready at our firm. So how do you do things each day to better support the end of the year when you're going to go under audit? So I'm going to be talking about some of the practical tips. Before we dive into that, though, I just want to get a better handle on who's in the room, just so I can give some context to some of the examples, some of the types of clients that we've worked for, observations. So Kim's going to launch this poll, should be up on your screen right now. If you want to help me understand who's in the room, what size is your organization? Let's just talk about total revenue. How large is your organization? And how many employees do you have? Because that helps us understand, are we working with smaller teams or larger teams? Organizations come in all shapes and sizes. So we already have lots of participation with that. Right, we already have about 70% of people participating. We'll give it another few seconds to clock in all of those other responses. Okay, Kim, do we want to go ahead and end the poll? See what the final results are? Okay, so it looks like 62% are over $1 million and have greater than 10, or I'm sorry, less than 10 employees. So that is about less than 10 employees or greater than 25. That's kind of what I expected. I figured there'd be a mixed bag of the size of organizations in terms of the number of team members that we're working with. So that's really helpful. Thank you all for sharing that with me. Okay, so let's go on into why internal controls matter more than ever. Look, I've been on this soapbox for a little bit now. Although this has always been part of my rant, and I've certainly been sharing these comments more and more regularly. I think internal controls are not just about avoiding fraud. It's about protecting your funding, regulation, and operations. When now more than ever, I think, especially on government funding, is becoming more and more scrutinized. Our funding, especially in smaller or even middle nonprofit sizes, are becoming more and more complex. It feels like we have an overwhelming amount of compliance requirements. We're trying to just to keep all of these things in order. Interestingly enough, when I worked as a CFO of a nonprofit, they were about $6.5 million in size. We had 14 different government contracts. And I think we had like 4 or 5 pages front and back listing all of the different things that we have to track, measure, or just outcomes that we're accountable for. I mean, this is incredible for $6.5 million organization that it's that cumbersome and you have that many things to track. So the more and more complex we get as organizations, and the more and more our industry is shifting into, these buzzwords like transparency and accountability. And while I want to celebrate that and honor that, it does become really burdensome for a nonprofit organization just to keep all of it straight, right? And the thing that I always talk about with nonprofits is like, what are those things that are going to be innocent enough in nature, but are going to end up on the front page of the paper? Because that's always what I worry about the most. Yes, loss of funding, that's something that, of course, we worry about, but also especially in times like now, where maybe some of our missions are a little political polarizing. Maybe they're coming under scrutiny. And some of these missteps that seem innocent enough, like a simple missing receipt, becomes much, much more significant. So I think from a reputation management and just overall confidence from either our board, our donors, or other stakeholders, I think it's even more significant now than it ever has been. And so when processes are outdated or documentation is missing, it can take a pretty big hit on our credibility. I've seen numerous cases with even just like minor auditor comments that become so exaggerated and misunderstood when picked up by the media. I've seen situations, even here locally, this was many, many years ago, but just a few missing receipts resulted in the FBI showing up to the organization. And I'm not trying to be an alarmist, but it was pretty incredible thinking, oh my gosh, what are they going to find? Come to find out they found nothing. And there was all of this, it was like a couple missing receipts for like $25 transactions, right? And it really destroyed people's careers. It destroyed the reputation. And it's one of those things that the public does not really understand the difference between this audit issue or that audit issue, or this control deficiency or that control deficiency. It's all deficient. It's all a big issue. When we know, as those that actually kind of operate in the space day in and day out, it's like, yes, that is a finding, but is it really something that's so significant that it should be used as ammunition? And even more recently, frankly, in the last couple of months, we had a new client that started working with us. They had just a couple situations where they did not have approvals documented, and it was picked up by some media and used as political ammunition. And Come to find out, if you read it, there was no money lost, there was no money mismanaged, there was no fraud that actually occurred. It was just simply some expense approvals that were not documented. And so again, the media picks it up and the general public doesn't really understand the difference between it because, I guess us accountants like to speak in really technical terms that can be confusing. And again, I don't mean to be an alarmist, but it's one of those things that, okay, we've always been expecting scrutiny and sometimes treated unfairly. I guess what I'm trying to say is I don't think it's going to get any better anytime soon. So how do we better protect our organizations from those kind of situations? And like I said, ultimately keeping our funders and auditors happy beyond just what people think about fraud. I think when they think about audit issues, they think about fraud. And we're going to talk about how that's not really the case. And that's kind of a bit of an outdated expectation for audits and what those mean. So let's talk about that. So the old risk for audits back in the past, when we think about it, was like embezzlement or theft, fraud, right? Somebody is stealing money from an organization. Now, that hasn't really gone away, but this is where I think some misunderstandings with the general public about what they think an audit does, or when you have an audit finding, it must mean that money has been mismanaged. That's not really the case, although certainly that was a concern and continues to be a concern. I think another old risk is that numbers just have errors, whether it's because of fraudulent reporting, they want to misstate the numbers, or simply because they have errors, they're just misstatements, right? We just didn't have the right numbers. We overlooked an invoice, or we didn't know how to record that particular transaction because it's really complicated, right? Maybe we just didn't have the right skill set or the experience within our accounting function to properly record things. That was kind of an old risk. And again, I think that's where some of these audit findings assume some of these old risks. What I've seen, again, because 84% of my clients are audited. I've done many audits, been through many audits. The new risk that I see, and more often than not, the findings that are showing up on these what they call management letters or audit reports, are things tied to missing documentation. And the thing is, people have asked me in the past, is there a certain dollar threshold for which you don't have to submit documentation? And when you get audited, especially when you get government funding, the answer is no. There's like no trivial amount. In the world, if you're a small business owner, and what the IRS says, they have this like de minimis amount. Some people said 25, some people said less than $100. They don't really keep documentation for it. They don't keep receipts. It's considered de minimis by the IRS. The financial statement auditors, they don't have a de minimis amount. So the answer is keep all documentation, right? And any missing documentation can and will be used against you in the court of audit standards, unfortunately. Failed approvals, so approval or documentation of said approval on things that are suggesting expenses should be approved, or maybe a budget by the board is approved, whatever those approvals might be, just showing a paper trail that multiple people are giving their stamp of approval on that. Outdated processes. So, if your processes are not necessarily up to date with what you're actually doing, or maybe they're just antiquated, they're not effective, not really even inefficient, just the things are slipping through the cracks, or they're just not supporting, especially grant compliance, that's going to be a problem. And then adequate skill in the finance department. What do I mean by that? So it's not before where you would just have the wrong numbers, and your auditors would oftentimes just fix those numbers and say, we're going to make an adjustment to your numbers, and this is the new number. Now I've seen clients come to us because their auditors have essentially said you have insufficient or inadequate experience or skill within your finance department, and we're going to write that up as a finding because we don't believe that you have the right talent or experience within your accounting department to sufficiently manage the complexity of your accounting, more or less. That's something that I've seen more and more frequently. And like I said, I think that's definitely a shift in the public accounting world, especially working with smaller to mid-sized nonprofits. I know back when I used to work in the auditing days, it didn't really feel like auditing. It felt like more we were closing the books for our clients, which in auditing standard world would suggest that's inappropriate and we shouldn't be, because there's a question of independence. Like, are we really auditing the numbers if we're actually the ones closing the books? It's especially tricky and hard for small organizations that maybe simply just have the budget for a bookkeeper that would not know how to do some of the advanced accounting work. And so those things are coming up more and more in these audit letters that I've been seeing. What's really confusing too, I think, for people, that there's not always a correct answer with There's no magic list of internal controls with very prescribed controls spelled out in a way that, okay, you do this exact thing and you do this specific thing. Sometimes sometimes it's spelled out in your grant agreement or your contract. For example, if you have federal funds, perhaps it describes eligibility and the specific things that you're supposed to be looking at to confirm eligibility. Those sort of controls can be very spelled out, but a lot of the controls that are not spelled out in contracts or agreements or what have you, it's really the auditors expect the organization to develop their own policies, right? And you have to prove that you are consistently following your policy. So time and time and time I see where organizations say they have a policy. Maybe it's an expense approval policy, for example, that says anything over $10,000 has two signatures. And then the organization fails to follow their own policy. Or I worked with organizations before that had an operating reserve policy. Well, they actually had more money than their operating reserve policy said that they were allowed to have, right? They weren't spending down their policy. So these funders and the auditors are asking, well, why are you not following your own policy? So that's actually a violation or an audit finding potentially if you've created these own rules for yourself that, by the way, you could always change because they're not mandated by anyone in some cases. But the auditors will write you up for not following your own policies. So that's a tricky thing within organizations. And again, some of those policies are driven by past funders or current funders. For example, a procurement policy, like anything over $15,000, for example, we have to get so many bids. Well, if an auditor comes in and they see that you're not following your own policy, they're going to potentially write you up for that. So unfortunately, that's where things get sticky and complicated. That there's really no just like complete right or wrong answer. There's no guidebook that spells everything out for you, unfortunately. All right, so let's talk about some of the consequences of weak controls. All of these, none of y'all are going to be surprised by these. Delayed reimbursements, reputation damage, we talked about that already. Loss of money, we kind of talked about that already. Public scrutiny and audit flags. Again, none of these are surprises. These are the things that keep us up at night already, right? But there's also some that are a bit not so obvious and other consequences that I've personally seen. And a couple examples I have of organizations I either know about or I personally worked through these situations with, that you can experience pretty significant increases in audit fees. So if you have internal control issues or a lack of internal controls have led to really, really messy books and your accounting is kind of in shambles, and your audit team has to help essentially clean this up or spend a lot more time trying to navigate the audit because you can't produce proper documentation or they have to go back and forth and you have to spend a lot more time looking for that documentation. I had a new client that came on board that had historically spent over $100,000 a year in audit fees for a $2 million organization. Now, we all like to complain about audit fees all the time, but $100,000 for a $2 million organization, I'd never seen anything like that. After a year of cleanup, incorporating these internal controls, now this was several years ago, we know if any of you all that get audit, we know audit fees have gone up pretty substantially over the last few years. But at the time, this was probably 4 or 5 years ago, we were able to drop the audit fees from $100,000 a year to less than $10,000 a year. And that is the power of having good internal controls and a clean set of books. Because in the absence of that, things go left pretty quickly and it takes the audit teams much more time to get through that audit. And ultimately, they charge us for that, typically. All right, so not only that, your auditor, I don't know if you all are kind of aware of the public accounting space right now. It's been really, really tricky for us even to be able to pinpoint auditors that can work with smaller organizations. And they've been pretty aggressively increasing fees as the talent in that particular sector and public accounting has been harder and harder to find. I'm not going to go on a rant about the shortage of accountants right now, but that's certainly the case. And so they're pretty aggressively increasing their fees and they're being very selective about the clients they're willing to take on. And so I've seen cases where auditors will disengage because they simply can't complete an audit. So if you don't have good internal controls or you don't have the documentation to substantiate these numbers, or they can't essentially document their way through their own peer review and their own quality standards, they're going to simply just disengage because they can't complete an audit. I've seen that happen where then an organization cannot forward that completed audit on to their funder. And usually when you disengage with auditors, they have a duty and kind of an obligation to more or less share the the reason for the terminated relationship with the incoming auditors. Because if there's any issues like fee collection or any concerns with like professional opinion and that sort of thing, audit firms through accounting ethics into that relationship and the standards for which the accounting profession has, they communicate and they have those conversations. So unfortunately, that might mean that you're not able to find a new auditor, especially these days, right? I've seen cases where we've had clients that have not had proper documentation as soon as they kind of come on board, and we're trying to get them through an audit, and their auditor just chooses not to renew the contract. They're not willing. And so now we're kind of in a situation where we have to go find a new auditor. And again, refer back to my last example, it's kind of hard to find an auditor. And typically those auditors are charging significantly more than what they used to in the past. And then I think last but not least, inadequate internal controls, especially as it relates to just missing documentation, your month-end close process falls behind, your books are a mess, turnover in finance staff, because the messes are just too messy. Okay, I've seen an organization that I've been following for many, many years. They're about a $15 million organization. They've had 4 CFOs in about 5 years in the constant revolving door because the mess is just so messy. And I suppose that maybe the incoming CFOs just don't see a path for which they're able to not only clean up the mess, but implement these internal controls and get everything in good working order, feeling like they have the resources, support, or otherwise perhaps that they need. So it's not just your auditors, but it's the risk of, your ongoing finance team or maybe your future finance team. So those are all risks that I've personally seen, not just once, but many times with organizations that have struggled with these sorts of things. All right, enough of that. Maybe none of that comes to a surprise to any of us. Okay, so these are some of the controls that in my experience, when I used to be an auditor has this idea of key internal controls. Okay, so there's lots of different controls, but they look at what are those key controls and how an auditor would define that, or what are the things that are more likely than not to prevent a material misstatement, a really big mistake in your numbers, right? What are those few things that they're doing that's going to mitigate the risk of fraud or huge gaping mistakes in your holes in your numbers, right? These are the things that an auditor would identify as what they call key internal controls. And so an auditor will typically come in and really pay attention to those key controls. Again, you might have lots of other controls in place that might serve you or might be required by your funder. But it's interesting, like, for example, you having 2 signatures on your expenses, like over $2,000, may not even register to the level of key control. So your auditors are not really even looking at that, perhaps, maybe. What they're really looking at are some of these kind of must-have, and those are going to be segregation of duties. Are you an organization that has one accountant that's managing all of the things? That throws up some red flags, that it puts that person in an opportunity that maybe they could end up committing some sort of fraud, or maybe it could be a situation where there's not enough oversight and not enough people reviewing the work to ensure that errors and mistakes are not happening. So segregation of duties, y'all have probably seen that in your audit letters or you've heard about it. It's a big deal. How do we kind of divide and conquer some of the financial related tasks, even in small teams? Auditors expect that. Documented approval workflows. So like if we say something needs to be approved, or our grantors expect things to be approved, or just general good best practices would suggest that we need to have some level of approval documented somewhere. And do we have workflows established, and are we consistently applying those, right? That's something that they look for quite often, because again, like the theme in all of these is just oversight, is leadership paying attention, not just senior leadership within the organization, but also the board, the finance committee. Are there multiple sets of eyes looking at things to make sure that if things were questionable, whether it's because of the dollar amount, maybe we're paying a fictitious vendor, or fraud was happening, or maybe there's just mistakes in how we code transactions. Like, are those things going to be caught through the multiple sets of eyes that are looking at that? So auditors really like to see evidence that that's the case. Grant coding and restricted fund tracking is really, really, really important to auditors, and they want to be able to verify that if a donor says this is restricted for purple pens to be spent all this calendar year, that there's a clear path that you can prove that you spent those dollars on purple pens within that particular year, for example. This is admittedly, I think, the trickiest part for nonprofit organizations, especially as they scale, not just in size, but complexity of their funding. And then they start adding on more and more restricted dollars. And how do they develop a process to identify where expenses should go and how they should be tagged so that there's a clean trail? So the next thing, again, just reiterating evidence of leadership review, whether it's you as the accountant have forwarded the report to your senior leadership, they've reviewed it, maybe they've responded back with questions, or even leadership review, documenting those things, the review of the financial statements in your finance committee and having meeting minutes documented, same with your board meetings, just really showing that multiple people are looking at this on a consistent basis, right? So it's not just one time you have meeting minutes, but you are documenting that every single time you have a finance committee meeting, it's being documented there. Again, reiterating what I mentioned, that you have written policies for all of the things that you feel is appropriate within your organization, but more importantly, that those are followed. It's just like HR, right? If we have employment policies and we spell those policies out and then we're making exceptions to those policies, then, an employment law attorney would say, is it really a policy? And that's where you get in trouble in employment law, and same with auditing here, that if you have these policies in place, but you're not consistently applying them, they will ding you for that every time. They may not be aware of all the policies and all the violations because they might be looking at maybe a sample of items, but nonetheless, once they come across them and they identify it's a policy violation, they will no doubt write you up for that. Okay, so those are must-haves, but also required if it's applicable within your organization is thinking about all those contract-specific compliances, right? So looking at all of your different funding agreements, are there additional compliance requirements that are required? For example, federal audits or state, any sort of government audits usually are pretty notorious for having certain policies like procurement policies, conflict of interest policies, again, eligibility determination, steps, guidelines that you must, have. Maybe your grant says that you need to keep their, pot of money in a separate bank account, for example, anything like that. Your auditors are going to be making sure that you're operating in accordance with your contract. Oh, excuse me. Talking too much. Okay. Clear grant drawdown documentation. Is there a clear path, especially for federal funds? Let me back up. Especially for federal funds, excuse me. It's usually pretty simple to do a drawdown. You go down, well, maybe not anymore, but we're not going to go on. We're not going to talk about that right now. For most government funding, I don't even say most government funding. A lot of government funding is very intentional. It's maybe a purchase service contract. It's very detailed. You submit the services you've offered. They've reviewed them. They send you your money, right? They've done a really nice detailed review. Some funding sources, particularly federal funding sources, make the drawdowns super simple in the grand scheme of funding, but they don't really ask a lot of questions, right? Initially, you go in and you're like, all right, I want to draw down $100,000. You pull your money down, great. And they don't really ask any questions until you have maybe a periodic report due, depending on your funding source, or it could be all the way at the very end of your grant contract, could be a year, 2 year, 3 year, whatever. And then they start asking all kinds of questions. And then they do a desk review, potentially with the feds. And then they want to see every single line item, every single detail from like, okay, let's start with the requested amount that you drew down and let's go all the way back to the beginning and show me every single step along the way that led you to put that number into your drawdown request, right? From all the way from timesheets to your payroll register to like what hit your bank account, including all of your vendor invoices, all the way through. And they want to see that in a granular level of detail, segmented specifically just for their particular grant. So this is very, very, very detailed. So having those clear drawdown documentation is super important, especially for federal funding. I've seen the most, although there's probably some local and state government grants that probably operate similarly, but especially for federal government. And even if it's a multi-year contract, sometimes your financial statement auditors will ask for a potentially similar level of detail. Speaking of audits, let's differentiate between kind of two different audits. I keep saying audits, and for those of you that aren't really all that familiar with that process, there's I'm oversimplifying, two primary audits that I'm really referring to here. One is the financial statement audit. So these are your independent CPA firm that you as an organization, you have to go out and hire independently pay them tons of money. They come in, they review all of your books, maybe some of your internal controls. They give you an audited financial statement at the end of the day, maybe do a nice little presentation to your board. And then you have this like final deliverable that then you can send off to like grant applications or your funders or whoever, right? These are financial statement auditors. And I say that their main purpose is to ensure numbers are fairly stated and those key internal controls are correct and appropriately followed, right? That's not to be confused with what I call a single audit or government compliance audits. Sometimes they're done at the same time. Sometimes the independent government agency will come in and do their own audit. So the worst case scenario, I guess depends on how you look at it, the most time consuming and difficult for us nonprofits is when we have multiple iterations of these different audits by different people auditing the same thing. Some of you all may know what I'm talking about. So the single audit or the government compliance audits might be done at the same time as your financial statement audit. But in some cases, the agency will force you to go hire your own auditor. And you got to get your audit report and spend lots of money. But then they say, but we reserve the right to come in and audit you as well. And oftentimes they do. And I think that will continue. That trend will continue. So those folks, the compliance auditors that might be the same as your organizational audit or someone else, these people are really making sure that you're compliant in accordance with your grant agreement, largely centered on internal controls, and that there's a clear line, like I was saying before, between how your expenses originated and how they ended up on those invoices that you might have sent to your funder, for example. So again, these are things like program eligibility, procurement policies, like a lot of things that are spelled out in those grant agreements that are required. And these are things that people typically get dinged on a lot in those management comments. So again, sometimes your organizations might have essentially one person doing it, or you have multiple different people looking at these different audits. But these are real issues that get flagged in audits, sometimes regardless of the type of audit, sometimes more so in one type of audit over another. We've kind of talked about a lot of these before, but what we see real time, all the time, are missing documentation for expenses, missing approval of those expenses, inconsistent coding of how those expenses are put into your accounting system, right? If you have a telephone bill and it's getting coded a different way every single month, that could be a problem. Restricted grant tracking, we talked about that. That's a really big deal for auditors. And if you don't have good tracking for that, which I'll be honest, most organizations really struggle with that. And then of course, as I mentioned before, drawdowns. If there's not a clear trail for us to substantiate why we requested these specific dollars all the way back to the original source, like a vendor invoice, that becomes very, very problematic. And the problem is an auditor will typically start with a sample. Let's say, oh, they've got 100 different line items. We're going to choose 20. And we're going to look at those 20. And if those are good, cool. We're going to assume it's all good and we're going to move forward. But if they find some issues with some of those, then what they do is they broaden their population. And now it's like, okay, we're not going to look at 20, we're going to look at 75 now. And then you still have problems with that, then you know how that goes. So those are the real situations that we find more often than not get flagged in audits, very real cases. And I'm sure many of you all have experienced some of these before, but this is where we're here to offer some solutions. Okay. So that's what an auditor wants to look at. That's what your board might care about. That's what your funders might care about, as we've already established. But these are a few things that I find really beneficial for leadership to care about for slightly different reasons, maybe. Yes, we want to be compliant. Yes, we want to follow the law, but they also need to be focused. The leadership needs to also be focusing on things that allow them to think more strategically within their organization, to develop expectations about what should be happening with the organization. A myth is that audits will identify fraud. Audits are not designed to identify fraud. That is a myth. Now, they want to test key internal controls. If fraud comes up, they have an obligation, obviously, to report it. Fraud could be happening and your auditors may never know. In fact, you see these all over the news all the time that, oh, this has been going on for 10 years and maybe they've had an audit and an auditor just never happened to select that particular transaction to test and it just never came up. So that's a myth. And I would say management oversight will likely identify fraud. Good management oversight will likely identify fraud. Remember what I mentioned earlier, the auditors really rely on all those eyes looking at the numbers as a key control because they also believe that's what's going to help identify fraud. I apologize if that's bad news for most of you. Like, oh, I thought auditors will identify fraud. Could as part of their testing, but that's not their intention. It's a big myth. So these are the things that I think will help with not only identifying fraud, but also identifying just general mistakes, because not all errors are a result of fraud, right? It could just be an error. It could be a mistake. It could be a lack of skill, quite honestly, within the kind of accounting department. And I'll give an example. I had kind of a frantic phone call from a nonprofit a long time, a few years ago, and she really could not reconcile between the fact that revenues seem to be going really well. Like, we're earning lots and lots of money on my budget to actual report. It looks like we're exceeding the amount that we even budgeted. I don't understand, though, why I don't have any money in the bank. I don't really even have visibility into the bank, but when I look at these dated financial reports and what I hear from my CFO is we're having a hard time making payroll. So tell me how we're exceeding budget and revenues, yet we have no money to make payroll, no actual cash, right? So after taking a quick look at their accounting system, what appeared to be the case is they were recording revenue, recording what they call accounts receivable, and with the assumption that someday they're going to get collected, or they're going to collect those dollars. But the problem was that the bills, the invoices going out to the funders were riddled with errors. They were not being corrected. They were not being resubmitted. In some cases, we had no evidence that they were ever submitted. So while on the reports, you're looking at like, great, everything's humming along, but in practice, without that management oversight, without those questions of like, this doesn't seem to jive and make sense, perhaps we would have never determined that, hey, we had all these invoices out there that were never appropriately billed to the funder. And as a result, we were never going to collect on that. So it was just a matter of time before we were going to run out of money. A couple other things that you would want to look out for, and we're going to talk more about that here on the next slide, is just thinking about budget to actual reports. That's a really good tool. Again, if you thought you were going to be operating in this space and your actual numbers look wildly different than that, ask a lot of questions. Document your review of that, whether it's in conversations with your CFO, or maybe it's even just through email, following up with a couple questions, just kind of documenting anyway. Catching some red flags. We'll talk about red flags here in a minute, but then also cross-training your team and making sure that it's not just you, but maybe other directors within your organization can ask critical questions, create visibility with those financial numbers across the board. And then also within your finance team, if you're lucky enough to have more than one person, having that element of cross-training so that people can step in and fill in the gap for some of us that might be out for a temporary period of time, or unexpected turnover. I'm not going to go through all of these, but this slide highlights what I think are some common vulnerabilities that I've seen in recent or most significant fraud cases. These are, I think, what are I would identify as hotspots where mistakes or fraud often originate, where they perhaps could consider some internal controls first. I mentioned payroll here. Most organizations that we work with, and I'm sure you all are very similar, somewhere between like 60 and 80% of most of our clients' expenses are tied up in payroll. So it's kind of easier to conceal or hide fraud that might be happening within payroll, right? Because it's a process. It goes on a payroll register. Not everybody looks, or oftentimes nobody looks at those payroll registers. And you might find some fraudulent activity that's happening within the payroll. So a lot of auditors would love to see some sort of independent review of the payroll register. Maybe it's you have a HR person that submits payroll, maybe you have a bookkeeper that submits payroll. Is there evidence that there's a review, either electronically or manually signing, Adobe sign, whatever it might be, that someone else has independently reviewed it for some of these things listed here? Are we still paying the terminated employees? Have we ran multiple payroll runs? Have we created any unexplained changes in any of the withholdings or salary amounts that don't make sense? Auditors really like to see that. Another area is just reviewing bank reconciliations. So just, I still look at my own bank reconciliations and the corresponding bank statements as well to make sure that there's no weird vendors or duplicate payments or transactions made to employees. Or another interesting fraud example that I've heard of in the last couple of years, there was a CFO that was taking cash advances on the credit cards, because nobody was reviewing the credit card detail on the statements. And so, yeah, if it was coming up on the regular checking account and there were payments made to that person, it would have been identified perhaps. But in that particular organization, no one independent of the only accountant that was running the entire kind of financial space was reviewing the credit card, and they were taking cash advances on the credit card, which didn't find out. And they've gone through several audits, like the auditors didn't really review all of the transactions also on that credit card statement. So just kind of something to think about. And then of course, I've already reiterated this, like the higher level financial statement review. So reviewing those financial reports and looking for some of these things that might suggest a red flag. Again, maybe not necessarily fraud. It could just be, a mistake, some sort of unexplained variance that, needs some, deeper investigation. Okay, so I want to get into what are some of the practical tools now that we can implement to maybe make some of these controls a little bit easier. I've thrown a lot at you all, hopefully focusing on some of those that are kind of high level, that are most important to your audit firms, your funders, whoever it might be. But here are some practical I'm going to give you some practical advice on how we've been able to implement systems that help support this audit readiness, if you will. The good news is you don't need a full accounting department. I know segregation of duties is important for auditors, but you can do this with just having very clear roles, strong processes, and what I'll call like a diffusion of responsibilities. So what I tell people, if you're a bit overwhelmed, we don't really have great internal controls, where do I even start? I would suggest starting with audit feedback. If you've received an audit or your new executive director stepping in and you've got some messes to clean up, go get a copy of your audit and make sure that you also receive the audit comment letter. It's usually a management letter or any other sort of correspondence that might have accompanied that audit report. Sometimes it's not in the audit report. It's listed separately on a separate letter. So go to that audit letter, read that feedback, and sometimes you might have already had to address some of those issues, sometimes maybe not. If you don't know where to find this, just go back to your audit firm and they'll give you another copy of that. Start with your audit feedback because you need to address those ASAP, right? Also your grant requirements. So, and I would also suggest that if grantors, like a government agency, if they've also done an independent audit, usually they would have observations or recommendations for any internal control issues that they've noted. Go back to those sources, and that's the low-hanging fruit. Maybe not all that easy to implement, but at least you're showing progress so that in the next year when they come out, you've at least addressed those issues. And also start with like cross-role approvals, which we'll talk about how technology can help support that. So a lot of the things that we're going to be focusing on from this point kind of going forward is kind of diffusing responsibility and getting more people involved in the workflow or the internal control process. And I think a lot of times we just centralize all of these accounting, financial related tasks into one person or two people. And that's where the internal control really kind of breaks down, right? So I really like to think about this in 3 different phases where you have the preparer. That might be somebody that's like uploading or initiating a request. Maybe it's a staff person that is submitting an expense to be paid. Maybe it's your accountant that receives the bills in the mail and they upload it. Then you have somebody that's reviewing that and signing off on it, reviewing it and coding it. This could be sometimes the same person, but we need to maybe try to separate one or more of these. So you've got the person that uploads the receipt or the vendor invoice, for example, to be paid. Then you have the reviewer. Sometimes that might be your accountant that's reviewing it like, okay, that seems like a reasonable request. I'm going to add some coding there. By coding, I mean identifying what account, perhaps which department, perhaps which grant. Some organizations, the accountant will upload things and then they will circulate them to program staff, for example, to do the coding by grant and department and et cetera, right? So it's different for every organization. And then ultimately you have an independent approver that is doing a final sign off on these things. Maybe that's an executive director. Maybe that's a chief program officer. Maybe it's different people depending on the type of expense. So I've had situations where all development related expenses get final approval by the director of development. All programmatic, the program director, right? It just really kind of depends, but this is what I'm talking about by like diffusion of responsibilities and differentiating what makes sense within your organization. And the cool thing is that we can use technology to bake in these approval layers, and we can use that technology to automatically trigger one approval after another. And the cool thing is it's consistently applied across the table. For purposes of time, I'm gonna skip on over to that. So disclaimer, I do not get paid at all. I have no paid professional relationship to promote this tech stack by any single person, but this is the tech stack we use for every single one of our clients. For the most part, we use QuickBooks Online for the accounting platform. We use Bill, formerly known as Bill.com, for vendor payments. We use Divvy for a credit card receipt, management system, if you will. I'll talk a little bit more about that. And then Dex, we talk about that. We'll talk about that here in a little bit too. These are all very audit friendly, easy to use, not proprietary, meaning you as an individual organization can go set up all these things and have ownership over those things. It is nonprofit accounting compliant. You can build this out to track all of the things I've been talking about, and it bakes in a lot of these approval. They're also very low cost, which I'm going to talk about here in a second. I'm going to skip over it and give a little bit more insight onto Divvy. I really like Divvy because credit card is just the nightmare of all people that have to participate in the credit card process at all, right? Divvy is a completely free platform that you can essentially use as a credit card. Every single person on your team. I have this for my own firm. I have 60 some odd employees now. Every single person has their own Divvy credit card. You can load up budgets. You can allow spending thresholds, and they charge on that credit card. They have to upload the receipt. The receipt then has to be approved by their supervisor. And you have an entire clean audit trail of all of those things. You can do spending limits based on their role. It forces them, like I said, to upload receipts in real time. So this solves the missing documentation issue. It solves the credit card approval process issue, all of those things. So Divvy is completely free. So really big fan of Divvy. I use it myself within my firm. Bill, I also use myself. Bill, think about if Divvy is for credit cards, think about Bill for all of those vendor payments that you have to pay, either by way of ACH or check, right? So think about your utility bill or something like that. Although I like to have everything on a credit card if I can. But Bill is think about vendor payments that don't necessarily accept credit card. This is also great for any time you've gotten issues where you have multiple layers of review. So you can build out custom layers. So anything over $5,000 has to circulate for multiple approvals. You can even invite board members in here. So say your treasurer has to sign off on anything over a certain dollar amount, that can be done. All the documentation has to be submitted in order for the bill to even be processed and paid. So again, supporting documentation, and you can set up rules where quite literally you cannot pay a bill without proper approval. So if you've been dinged by these things, these two platforms will completely solve that problem for you. So I mentioned Divvy is completely free. Bill is a platform that charges a small user fee per month and then a per transaction basis. I try to get as much transactions on a credit card to minimize my fees. But with fewer and fewer real checks being processed nowadays, I feel like costs for these software solutions are becoming much more manageable. And I think the reward of sleeping well at night, not worrying about some of these control issues, is worth the investment of the cost. We also use Dex, easy for audit documentation. This is essentially replaced if you use Divvy. So if you have other credit card processes out there, credit card accounts out there that's not Divvy, Divvy is essentially a credit card company, then you need something for which your team can upload those receipts and that we can code them and we can make sure that documentation is submitted for all expenses. So we use Dex for that. It's been a really great system for us. Like I said, like 84% of my clients get audited, and this is a foolproof system every single time. Okay. Just a couple little highlights. If you don't want to take my word for it, these are a couple organizations that we've worked with lately that have been pretty big fans of this system. So, give a little bit of street credibility for other nonprofit leaders like yourself to be able to see that these processes really do work. This tech really works. It's fairly easy. And you're not the only one that's had maybe audit issues in the past or small teams. Some of these organizations only have a couple people that support the financial function. But if you wanted a little bit of validation on maybe some challenges that you've had or some peace of mind that, other nonprofits enjoy working with these platforms, there you go. Okay, so next steps, I want to leave some time for questions, so I'm kind of flying through these, I apologize. But next steps, this is just some basic practical advice that I would offer up for anybody that's like, okay, what do I do next? What is the next best thing to do? The reality is I would start having one-on-one conversations with your accountant to review reports together every single month. And maybe for them to point out the things that they would view as a red flag as the critical eye looking at financial reports, and kind of help you understand what are the things that stick out to them so that I can be better trained on how to look at these financial reports. And then also, as you're developing your expectations, you're able to ask very intentional questions too, like the example I gave. Why are we exceeding our revenue budgets, but we don't seem to ever have any cash? Why is that the case, right? I already mentioned too, review your audit for management control comments, come up with a corrective action plan if that's applicable for you, or go back and look at your funder audits if they've come out and done any site visits or have any sort of desk review audits or anything like that. That's low-hanging fruit, an immediate plan for where to start. And then just having an open and honest conversation with your team. I really want to reiterate this. It's amazing to me that I've not really seen a correlation between strong internal controls and like the larger size organization or the smaller size organization. It's not really about organizational size, because I've seen really great organizations that are quite small with internal controls, and I've seen really great ones that are really large organizations, right? And what I've seen is more of a culture from the top. They always say tone at the top. And if the leaders of those organizations are making that a very big deal because they don't want to end up on the front page of Business Journal, then they set that tone for the organization. And I will tell you, a lot of times we get called in to help transform clients and help implement some of these things with all of our experience dealing with auditors. And I've said this to some clients where maybe those relationships didn't work out long term. I said this to a client that didn't really want to embrace the internal controls that we decided we had to part ways with. And I said to them that I have a 0% success rate transforming internal controls and solving these problems with no buy-in from the person at the top. If we are not empowered to really think about how we're going to have every single person on this team be interacting differently, if a person is spending money, they have to help manage the documentation and approval, right? It has to be beyond just the accounting function, because we cannot do that alone. I can't control whether, the other 30 people on your team are submitting receipts. I can't explain that to an auditor, right? So really encouraging everybody, that's here listening, if you're having some issues, really kind of think about what the tone at the top might mean for your organization and how you could create some buy-in. Okay, last thing I'm going to leave you all with, Kim's going to drop a link here. I've been working with nonprofit organizations, like I said, I don't know, close to 20 years now. And I get asked this question all the time: what do the most successful nonprofits have in common? And we talk about internal controls, strong leadership, that sort of thing. But we created this financial blueprint a few months ago. It's essentially a 30-point principle list of all of the things that we've seen the most successful clients have in common. And we're not just talking about financial metrics. A lot of it is cultural, frankly. If you want to get a copy of this, it's totally free. Go to this link, click on it, you can download it. And like I said, it's kind of like my observations that have, what the common thread is between the most successful organizations. All right, so with all of that, let's open up some questions. And
Okay,
I'm going to just flip over to this last slide real quick, just so you all can see it up while I'm answering these questions for more free resources.
Okay, so a few about Divvy, why Divvy versus Ramp, and also why have Dex in addition to Divvy and Bill.com.
Okay, so my understanding with Ramp is that I can't speak to Ramp too much, but I'm hypothesizing because there's like Expensify and there's Dex and there's Ramp and there's all these different software platforms that are trying to compete and do the same thing. I can't speak specifically to Ramp, but Divvy is its own separate. Here, I think I can probably show it to you all. I don't know. Do I have it? Kim's probably like, Tasha, you should have it. So Divvy, Bill is actually owned by Divvy now. No, Bill owns Divvy now, and it's actually a specific credit card. And it's not just a software solution that connects with your credit card. And the reason why I like that is because depending on how your bank sets up your credit card accounts, if you have an independent bank, then the way that these platforms, Dex is included, QuickBooks Online, all these integrations between these different banks, they don't work so seamlessly. Sometimes better, sometimes not. What I really like about Divvy is that it's its own credit card, it's its own platform, and all of those transactions by user come through that platform very seamlessly. And by creating a Divvy card, which by the way is free, I don't think Ramp is free. It allows visibility both on your employee side and the person managing kind of the administrative side of things to be able to see who is the culprit for not uploading those receipts. And then also visibility within those appropriate supervisors to be able to approve those. So if I had to give a very simple answer, number one, Divvy's free. Number two, it's one seamless solution rather than, I think, if I remember, unless Ramp's changed, software tech companies change so fast I can hardly keep up with them all. But Ramp is like a third-party system that pulls in information, just like Dex. Dex does the same thing. It pulls information in from your actual credit card company, whereas Divvy is like one whole system. So that would be my answer to that. And why do you need Bill if you have Dex? Was that the question?
Yeah, why would you, yes.
So think about Dex as like a virtual inbox. So it's a receipt collector, kind of like Ramp, kind of like Expensify, if you will. So for those that, if you're like me, you got to rip, this credit card out of my, cold dead hands. I'm not giving up my credit card or my points or whatever. If you don't want to move to Divvy, then an Expensify or a Ramp or a Dex makes sense for you. That's more of a receipt collection for transactions that have already happened. Bill for vendor payments are for initiating approval and payment for vendor payments that need to go out. So think about accounts payable versus like receipt collection, kind of virtual inbox.
Okay, there's lots of questions about Divvy, but I think you answered most of them. So another one says, we are small and having trouble finding an auditor. Any additional tips? All volunteer organizations with one independent contractor assisting me as a treasurer.
Ugh. Um, I wish I had a better answer. I was just having a conversation with an audit partner, much larger firm, and we were talking about this at lunch today, right before I came on. This is a real problem, especially like we're in St. Louis and Illinois. I think I can almost see it from here. And Illinois has like a threshold of $300,000. Is a threshold, and it's almost impossible for an organization to find audit firms that will do those audits. And we've had numbers, I've talked with several audit partners, even smaller firms that essentially won't touch an audit anymore for less than $20,000, which is obviously very cost prohibitive for smaller organizations. I've not been able to find the solution to that yet. But typically we have found those firms that are much, much smaller in size in a very local way. Looking in your local community and just seeing if there's any audit firms out there might be your best bet. The concern I have for that though sometimes is not all audit firms are created equally, and I've seen examples where the quality of those audits are tricky. So yeah, that's all I'll say about that. I wish I can help. I wish I can help. Yeah.
Another one, if additional accounting costs are strictly associated with a program specific grant, can those costs be considered a program cost?
Okay, that's a good question. And I've never found like any specific guidance, but this is how I've typically done it. I have put it as general and administrative expenses because your financial statement auditors are going to fight with you about whether it's administrative or program, even though you have a program contract that says they will pay for it. But then what I do is I assign it to that grant so that whenever I go and create my invoice for the grant, it shows up on that invoice, and then I can get reimbursed for it. And then I have all the documentation to say like, this is why I charged you all for that grant. So I keep it in general administrative, but I tag it to that particular grant. If it's a substantial amount of money, you could probably try to negotiate with your audit firm and convince them otherwise, but I don't know if I've ever been successful doing that. And usually it's a couple $1,000s, right? You write it into a federal grant, like, oh, we're going to write in like 2,500 or 3,000, $5,000, whatever, for additional bookkeeping support. Your financial statement auditors would probably challenge that.
Another one, can TCCFO help write our internal control processes and policies, or do we have any templates to help plug in your own organization specific info?
We'll write that down. I don't have anything yet. We thought about it. I just kind of ran out of this month because it could be very individualized, but that's definitely a template we will consider in the future, and hopefully we'll share that in our newsletter. Which, shameless plug, if you want to subscribe to our newsletter, go to our website and opt in for that. That might be a tool. We've been trying to add more and more templates to our new website. So if anything, we can maybe try to do kind of at least a starter template. Every organization is slightly different, but yeah. Not yet.
Some Similar questions, I think just a little more clarity on, people are asking Divvy or Dex, not both together.
Yeah, correct. I mean, assuming that all of your credit card transactions are all on Divvy, then Dext is not needed. Part of the challenge is if we have some clients that for whatever reason, they have some employees on Divvy, but they have other credit cards out there for whatever reason, maybe they have like a Home Depot card that their maintenance person uses. Now, I would argue you can just move everybody to Divvy and simplify. I'm all for simplifying. Then Dext is not really needed. But a lot of our clients are reluctant to move to just moving their banking or their credit card. It's just, it's a process. And so we deploy Dex straight away, just to have a virtual inbox, if you will, for their team to be able to submit that documentation. And then eventually maybe they decide that they want to move to an easier credit card management platform. I personally like Divvy better. I don't use Dex personally for our firm because every single person has a Divvy card. So we just use that instead.
One more, does bill overlap with QuickBooks payments? Does an organization need both?
Um, Great question. They don't necessarily need both. One of the limitations with Intuit that I've actively been in conversation with them is that there are some limitations with QuickBooks bill payment that it has the proper approvals, but everybody that's going to be approving those expenses, they have to be users of QuickBooks. The problem is the number of licenses, right? And I think depending on the tier that you have, it might be limited to like 3 or 5. If you're a larger organization and you have 15 different people that may at some point need to approve something, then you run out of users. And I think they're trying to work on that, but right now that's not addressed. Don't quote me on this, but in their QuickBooks is evolving in their platform every single day. They might also be limiting some of the categorization and coding that is important for some nonprofit organizations, specifically not just their account, but if there's a class, if there's a grant that you're trying to restrict to, if there's a location, some of the features within QuickBooks, like bill payment, limits the dimensions, we call it, that can be categorized as it goes through the approval process. And that's super important for auditors. I have hope, no shade against Bill, but I have hope that Intuit continues to develop their bill pay platform to make it more inclusive of the nonprofit space. And believe me, I'm actively advocating for the nonprofit community at the Intuit headquarters as part of my volunteer advocate for the nonprofit community on that space, because it'll be much simpler if we could just operate within one system. Not quite there yet, but I know they're actively working on it. Okay, I know we're a few minutes over. I'm cool with just getting through the rest of these questions, Kim, if people are okay with sticking around, but I also want to respect everybody's time as well.
One, I think you pretty much answered a few times, but they're just fair or wanting to re-ask nonprofit, if their nonprofit has credit cards through their bank, would you recommend Dex? You would recommend Dex for receipts and approval flows?
Yeah, you can, but like for me, I feel like the approval part specifically is a little clunky. It's a little clunky in that way. And for that reason, it's like there's a reason why I go with Divvy, because I think it's just much more seamless. It's much easier. It's much more intuitive. Plus Divvy integrates very seamlessly within QuickBooks as well. So if you're looking for approving, so some of our clients, they will have their credit card statement approved as a whole. I don't think Dex offers that solution right now to individually approve each transaction. So our clients, if they're on Dex only and they're not using Divvy, they have to get their entire credit card statement approved. What I like about Divvy is that you can have transaction line items approved, which may be important to some of your funders or your grants, et cetera. So yeah, for that reason, I mean, I just like moving the credit card processing to Divvy personally. Like I said, I have zero, I don't know if I've ever met anybody from Divvy before. I have zero financial relationship with them. I'm a big fan of their product for that reason.
Someone asked, what are typical audit fees?
Depends on your organization. What I'm hearing right now, unless you work with a really, really, really tiny firm and you're a really, really tiny organization, maybe you can get it around, again, maybe you're like 500,000 or less. Like I said, in Illinois, the threshold is 300,000. So that's quite a small organization. And I would be surprised if their audit fees were less than, $8,000 or $10,000. But what I'm hearing now is most firms, even considered small firms, so think about like 25 people, those firms will not even touch an audit for less than like 15 to 18,000. Some of the what you call maybe more regional firms won't touch an audit for less than like 25, 30,000 per year, and those go up. So it's incredibly expensive. So, if your state requires that, definitely keep advocating for the nonprofit community.
This was the last question that was up there, because where can I find examples of internal controls for smaller organizations?
That's a great question. I don't think I have anything off the top of my head that I can recommend that's kind of an exhaustive list. You can probably research controls over different things. If you kind of search for example controls on bank reconciliations or whatever. I don't know if I have I mean, there may be guides out there. Maybe we need to create a guide, Ken. Yeah, I don't know if I have a great suggestion for kind of an exhaustive, like, or even just a really good library to kind of pick and choose from, because controls are all different for all different sorts of organizations. All right. I'll just tackle both kind of Rick and Tanya. I'm seeing some comments on there. Okay, so it sounds like Ramp is a credit card. That's great. I didn't realize that with Ramp. Yeah, it sounds something similar. Ramp, I'm certain, integrates flawlessly with QuickBooks as well. So I don't know, Rick, if you said that's free. So thank you for recommending that for other organizations. It might be a good solution for some. And then, yeah, Tanya, Divvy, yeah, it's a credit card. So yeah, you would have to move off of your bank credit card into, you would have to move from your bank credit card to their actual like credit card. Yeah. And like I said, it's free. I suspect it's free because they get all those transaction fees, right? Every time they process the credit card, because they are functioning as the bank. So I'm assuming that's why it's free to users. But hey, we like free software. Okay, this has been lots of fun. I know there's still several people on. I'm going to share my screen one more time. Like I said, we've been trying to do a lot more work on providing free resources. I'm going to go ahead and drop that. In my free time, if you all don't know already, I host a weekly podcast called A Modern Nonprofit Podcast that is basically on every streaming channel. Just search for A Modern Nonprofit Podcast. You can also head over to @the Charity CFO on YouTube, and you can see full video of those same episodes if you're interested in that. So that's a lot of really cool information. We don't just talk about accounting. We talk about all different topics, fundraising, leadership, all issues related to nonprofits. So you can check that out there. We also have a blog and a newsletter on our website. In addition to some free templates, we're continuously adding to that library all the time. And then all of our webinars, we just did a webinar last month. We're going to do another one that'll be announced here shortly. All those webinars, just kind of keep an eye on our website, refer back to it, and you'll be able to see all of the previously recorded webinars there on the website for even more free resources. Thank you all so much for joining me. It's been fun. Like I said, super passionate about this and all my different experiences. We'll see you next time. Bye now.